Hello, everyone. My name is Robin Dolezal. Today is Thursday, February 2nd. With me, as always, is Dan Nentel and Alex Pars. Together, we are with Ironwood Financial. Good morning, gentlemen.
Good morning.
Morning, fellas.
Before we get started, I want to wish you a happy Groundhog's Day. Yes, spring is on its way.
Did you look it up?
Yeah.
Oh, because living in the Southwest, I haven't really cared much about Groundhog's Day since I.
Well, you might care about this, Dano. Today is also National Tater Tot Day. Not sure what you're going to do with that, but
Well, being from Minnesota, there's nothing better than a good tater tot hot dish.
yeah, I think it was either this year or last year we actually introduced the boys. They're 7 and 9 this month to tater tots because they still didn't know what that was. So they're pretty pleased with that.
Well,
Anyway, well, good to see
Once a
you
year
guys.
only for them, right?
Huh?
Once a year only for them, right?
Yeah. Well, it's funny. Grayson doesn't really care for French fries at all. I mean, he likes a tater tot, but if we get takeout or go out to dinner and they get whatever they get, it's always fries served, and he never cares for the French fries. He's very odd in that way. So I guess that's a blessing. Anyway, well, so we got through January. We're at the beginning of February, and it looks like the markets are happy this year. Thank God. Huh?
yeah,
Dad. Dan.
I'm old enough.
Dan, give us a little synopsis. What's going on in the markets?
Well, we have to remember that we're having a lot of people every January. Everyone gets their wellness kick, and they're I'm going to eat better, work out, and a lot of people are like, oh, I'm going to finally get my finances in order. And last year, a lot of people did the dig their head in the sand and not look because there really wasn't a hiding spot last year. I mean, the safest investment in the world is a treasury. And if you decided you wanted to buy a 20-year treasury, you lost more than 33% last year. And then the darlings of the pandemic got crushed. The NASDAQ was down 33%, S&P down 20%. And there wasn't a place to hide. And so right now we've got a lot of bottom feeders that are saying, well, it really at some point must go up. PE ratios are at a pretty good spot. The tech's leading the charge, but you have to remember they were the biggest loser last year. So they're getting back some of their losses from last year. A lot of that comes with the idea of, and it's interesting, I read an article today, Wall Street doesn't believe the Fed any longer. And part of it is, Dr. Powell came in yesterday and said, there's signs of inflation waning. We're still going to raise interest rates, and we're going to raise it only 25 basis points. And I believe that, Alex, correct me if I'm wrong, I thought they said they were going to do 35 basis points this meeting and maybe 25 in March, but they did 25 basis points, the market, and then he came out with, well, the jobs report was hotter than expected. I mean, there was conflicting information as to whether or not the hot economy had slowed down. And Wall Street said, we don't care anymore. PE's at a good spot. We're going to buy stuff that is a good buy and hold it for a while. And it seems to make sense. I mean, last year we played the market pretty well and everyone got really beat up and we got punched a little bit. I mean, it hurt, but we've had a nice recovery this year, mostly because we did some exploration into energy that did well. And the biggest part that helped us is we really went short-term in our bonds and they're maturing. And again, we've talked about it multiple times on our Zoom meetings is bonds are actually somewhat attractive. There's a lot of money in the sidelines and you can get 4 to 6% without too much effort, which is great for those people trying to take an income. But reality is right now, it's the Fed seems like they might be done. I mean, Alex has that, what do you say when you're on a long car ride, which doesn't really hold true anymore because everyone's got some kind of tablet. But I remember asking my dad, are we there yet? Are we there yet? And we're trying to figure out if the Fed's done. And they won't tell us, but they're close. And
they're close. It seems like it, yeah.
So
Alex, did you actually watch Jerome Powell talk yesterday, or did you read the Cliff Notes?
I read the Cliff Notes.
Okay.
Just so you know, Dan, if you take the tablet away on the way to the grocery store, you'll start getting, are we there yet?
Not anymore. All mine drive. They just say, they kind of tell me when they're leaving. They don't even ask anymore.
Yeah.
So I know he said we're not done yet, but Alex, what did you get? Did you hear anything? Did you hear anything surprising, or did you hear, that's exactly what I expected to hear from him?
Yeah, nothing surprising. The only thing that was surprising to me was that jobs report, which is going in obviously the wrong direction by having, what was it, a 4-month high in available jobs. We want those jobs to go away so that they stop raising rates. But They didn't change their mind. They didn't do anything more aggressive. They said exactly what we expected them to, with a slightly nicer twist. So what they said was, the battle's not over. We're going to keep fighting till we win this. And they keep saying that. But he did say there's light at the end of the tunnel this time. And I think he used the word disinflation, which honestly, I'm not sure I've ever heard before.
Right.
But so they are admitting that they think they're near the end, but they're not at the end. There are more rate hikes coming. We knew that. We're expecting maybe one or two, who knows, but small, and hopefully more time in between them. The negative news, sort of, is, this idea that the stock market is, or not the stock market, the economy is really slowing, is pretty much hogwash as far as I can tell. They just revised GDP numbers up to 2.9% for the fourth quarter, which, if you recall back to the years following the Great Recession, we were happy with 1.8. So 2.9 is still very robust growth. Jobs sitting at 11 million unfilled jobs. Those are two very strong indicators of a very healthy economy. So anyone who says that the Fed has gone too far, that's not true yet. Certainly isn't. Even real
He
estate
does
is
keep
showing
saying, I'd rather go
resilience.
too far than not far enough. So I'm sure he'll just keep going. So he obviously did a quarter point yesterday. I'm expecting he does another quarter point after that. We're currently at a Fed funds rate of somewhere between 4.5 to 4.75. So if we do another one, that'll be somewhere between 4.75 and 5. I think when we last talked, the goal, I thought they said, was like 5.1. So we might get another couple rates for the year.
Right, and that's a moving target. They changed that. What's interesting, again, is since, in the last 3 months, interest rates have come down significantly. Right. So if you remember looking at some of those high yield bonds, like the 2026s, they were paying about 9, and now they're down to just under 8. Mortgage rates have come down, and everything like that. So it's very interesting that it's all about anticipation, expectations, and the markets, not just the stock market, but the interest rate markets, have started to think, okay, we've peaked. So
I do have a question. So they did an adjustment to the required minimum distribution and raised the age to 73, and they actually lengthened the table for mortality. So many people forgetting about the fact that the market's down. So your RMD, if you're over the age of 70 and a half or 72 or 73, based on when you were grandfathered in, excuse me. So you might see a smaller RMD this year, but I've been having this question a lot, Alex. And so let me see how your crystal ball works. Market's up pretty good year to date. Should we be taking it? Do you anticipate this run to continue? I know last year we were saying we think it'll do better after September, and it did. So to wait last year was a good idea if you didn't do it in the first quarter. Is it something that we should be anticipating to take early, or do you anticipate this rally to keep going?
Yes and no. I mean, I'm kind of ambivalent. My standard answer is, hey, if it's up from where they calculated it, it's a good deal. Yep. And that's the case right now. Again, we always have bond money that we can use if the market goes down. But in my head, and again, this is pure crystal ball weather forecast, if you will, I see the stock market doing well the first 4 or 5 months of the year. As we get from, are we there yet, to, yay, we're here. And then I think reality is going to set in, and people are going to say, okay, well, now interest rates are a bit higher, demand is lower, and earnings aren't growing as quickly as we hoped. And then the stock market has a bit of a, letdown, if you will. And then after that, the theory is that they start to lower interest rates again, or at least that's what most people think. And the stock market should really enjoy that. So depending on the timing of all those things, it could be, any time could be the best. Again, my hope is we get that, the next meeting, for example, I don't know if this is what will happen, but if they say, we're going to pause, we've raised rates a bunch, let's see what happens now. I think that creates another stock market rally. Whether they say that the next meeting or the meeting after that, who knows? But until we get that information, I mean, the stock market's holding its breath, waiting for that.
Gotcha.
And once they get that, I think they'll be happy.
And I have one last question. I know you hate this question, but I'd love to put you on the spot. So we obviously had some energy last year that did fairly well. Everyone that you've been reading is talking about tech, which has already done crazy, but financials, maybe medical, pharmaceutical. If you look at PE ratios, it'd be silly not to have more small mids, and I hate to say it, even internationals. Is there anything that you find that you're more excited about than others, or is it just the fact that pricing's come down?
And this is a tough one, particularly right now, because we still have, there's people who all of Reddit crowd who did wonderfully in 2021, got crushed last year. Now they're like, it's our time again, at least the last week or two. Okay, so if you look at some of these stocks, they were down 99%, ready to go out of business. Fundamentally, they look terrible, and they've gone up 400% in the last few days. Okay, they still look like they're going to go out of business, but their stock is up, right? So, but again, remember, Hertz was declared bankruptcy, and then their stock went up 400%. And the CEO's like, "What are you guys, crazy?" So, so there's stuff out there that's reacting that way right now. It's just super risky, and not something that you would want to put real money into. Something maybe for play money, but real money, it's back to what you said with the fundamentals. The PE ratios look good. There's a lot of solid companies with good profits. The stock market as a whole looks good. And then there's a lot of side bets that are paying off today and yesterday. Whether they have longevity, who knows?
And I apologize. I have one last question. We were talking about how bond yields were up, and we were hoping to have a little rally in the market like we're seeing, and maybe get our clients more conservative, because the whole buy stocks and just don't look, which is what we had to use really for the last 20 years. But now that bond yields are better, but pulling back, are we still hoping to get more conservative this year?
Yeah, and that's we are hoping to, and it's a question of what the weather looks like on the day we decide. So right now, again, take 2023 for example, right? Bonds are up, right? 2 or 3%.
Yep.
Sectors of the stock market are up 5 or 10 or 15. Okay, so had we switched, yeah, we would have made 3%, but instead we didn't switch, and we've made a lot more depending on the particular sector. And that ratio should still hold based on where PE ratios are at this point. So until we get that 10 or 20% that we're looking for out of the stocks, I don't want to settle in and say, okay, I'm happy with 6 for a year.
Thank you.
So hopefully, again, that there's a confluence where we can get first that big bump and then the more conservative.
Alex, when you always know this off the top of your head, which always impresses me. When the Fed talks again, what's our next meeting?
6 weeks
Okay.
from yesterday.
Well, that's an easy number to remember. That's less impressive. All right. Well, I want to thank you guys. This is always a fun time to do. And we'll obviously do this again, probably in roughly 6 weeks after the Fed talks. If you missed any of our other discussion, folks, or our videos, you can find them on our Facebook page or our website, ironwoodfinancial.com. If we did not answer any of your questions today in this video, please don't hesitate to reach out. We are always available. You can reach us at 888-271-4646. That goes for anyone who's watching and that's not a client as well. You want to bounce some ideas off us, please utilize us. We'll be a resource for you. Guys, have a great Groundhog's Day.
You too.
All right, we'll talk soon.